Hello, bit of a link fest going on today, lot to get through. Before I go, thanks for the comments on yesterday's video. Right, let's start with what Steve Keen calls "it's the debt, stupid." Over in America, the blue is public debt, government debt, as a percentage of GDP. Now getting on for about 100, and everyone's going wild about it. But the red one is the private debt. The first spike was 1930s. It dropped back, and look how it's gone, all the way up to 300% of GDP. But nobody seemed to bother about that. It's coming down, and government debt's going up. Why? Because if you look at the shape of the chart, when one goes up, the other one goes down. So what's going to happen now if the American public deleverages an awful lot more of that red line? Where do you think the blue line is going to go to? I've gone to the St. Louis Fed to get the M2 money stock velocity, the turning over of the M2 money stock. This is quite interesting, but I've got no finished picture for you. All I can do is ask you what you think of it. Have a look at, this is the velocity of M2 going back to just before 1960. The first spike spikes up into the grey bar. Then the 1970, it spikes up into the grey bar, which are recessions. It goes down. It spikes up into another grey bar. Then it spikes up into the double dip recession of the 80s, and it goes down. And it goes up to 1990, and it kind of just before the recession spikes, but then a little small spike in the recession. And you would have thought here it should have come down if it was to follow past trends, but it doesn't. It goes right up and forms a head and shoulders, falls off the right shoulder through the recession, then spikes up again well before the recession and falls down again through the recession. It seems to have changed its modus operandi, its shape of doing things, but you can see it's dropped off again now, much lower than how it's been recently, in the recent aspect of the new way it does things, but it's only down to where life was quite good in 1965. So just to check, I went to this chart, chart 3, which is the actual M2 money stock in numbers, and it was nearly nothing because we didn't have big numbers back in the 60s. And you can see it's gone up through 1, 2, 3 all the way through the trillions up to nearly 10 trillion now on quite a smooth curve. But I don't like the look of the way it's going at the moment. It's going a little too exponential looking. I haven't a clue what it means, but I don't like the look of that. I think that's one of the things that can't continue, so it won't continue. But why and then what happens, I don't know. Rules stretched as green cards go to investors. This is in America. We know it's so hard to get a green card to get into America. Affluent foreigners are rushing to take advantage of a federal immigration program that offers them the chance to obtain a green card in return for investing in construction projects in the United States. And if you read at the bottom there, as long as you invest at least $500,000 in a project, buy a new home, you're in with a green card. What do they take? Your raggedy, your poor and woe begone? No, they'll take the rich bastards, and good on them, sensible for doing it. Reuters gives us immigrants founded half of top US startup companies, and so maybe quite a lot of those people buying their way in will be the type of immigrants that start new companies and employ people. But in the background we have homeless kids in the US number 1.6 million, a study shows. That's a lot of unemployed kids. They might be employed one day. Homeless children, 1.6 million. It's a lot. And meanwhile, in Washington, they're arguing over the to extend the payroll tax thing. Democrats and Republicans are arguing over the price Democrats are willing to pay and Republicans are willing to accept in order to extend the payroll tax cut for a full year. They're kind of agreeing on 2 months. Republicans want, among other things, the Keystone XL pipeline and further cuts to discretionary spending. Now, I go, what the hell? To push out the payroll tax cuts, the Republicans want a pipeline to run from Canada to Texas. What's that got to do with the price of fish? Over in Australia, getting out of America now and going into the world, Australian mortgage insurers are put to negative watch. QBE, Genworth and Westpac. Australia is an interesting one. It's one of these places that'll do well as long as the world's doing well, but could be in for a horrible crunch if the world horrible crunches. And is linked, although we're going to Europe here, Australia is linked to this chart. This is kind of, it's actually the current account balances of Ireland and Spain, but it's kind of money flows in as opposed to money flows out. Money flowing, a lot of money flowing into the country in those dates going back to 1990, and it is a link to Australia because it's been a carry trade currency and a lot of money, capital, has flowed into Australia, and that inevitably causes bubbles, as happened with Ireland and Spain. You can see starting in 1998 at the start of the euro, Spain and Ireland, those bars pointing a long way downwards, meaning deficit, or a lot of money was pouring into the country. And it caused bubbles which popped in 2007 and 8 with grave consequences. But note again, the Irish and Spanish governments were doing very well on the backs of this, and their accounts were looking very strong. But there were bubbles forming in the country, which overwhelm the government when the bubbles pop. So, since then, what has been going on? This is productivity improvements, let's call it that. How much your labour costs are going up and down compared to other people. Now, the United States is about level on this, so if you're below the line, you're getting competitors against the United States, and if you're above the line, you're getting uncompetitive against the United States. But we're really talking intra-Europe here, and Ireland's the only one that's reducing its labour costs. And that is what they're meant to be doing, apparently. But look at Spain, is well over there on the right-hand side towards the big boys with 3.9 increase. Its labour costs are not being decreased, they're being increased, and they're becoming more and more uncompetitive. Reuters report, Europe should consider more help for Ireland, says the IMF. So it looks like the EU can't say it, they've got the IMF to say it, and Ireland probably will get some sort of help. But top of the IMF list there is calls on Europe to give more aid to Irish banks. Spanish banks, bad loans, the chart there in blue, going up again. It had a bad time of it in 1994 where it had a big recession, and delinquencies went up. But delinquencies are on their way up again, and in the background there, the buff coloured is GDP, and you can see it's dropped down through the recession on the right, and it had a little try at being positive, but is rolling over again. So that blue line will go up and up, and Spanish banks will come under more and more pressure. Meanwhile, in the rest of the EU, we have Greece, and the suicide rate in Greece has reached a pan-European record high in Greece. And before the financial crisis first began to bite 3 years ago, Greece had the lowest suicide rate in Europe. Meanwhile, governments and banks are trying to sort this out, but there doesn't seem to be anything within the old rules that they can do, so they're making it up as they go along. A provision tucked into the Italian government's budget law last month is designed to diffuse some of those pressures. It allows the banks to use their government bonds to purchase army barracks, office buildings and other state-owned real estate that the government has been trying to sell. The government would then lease the properties back from their new owners, and the banks can package the new income-producing properties into asset-backed securities which can be pledged as collateral with the ECB in exchange for loans. Doesn't sound like anything can go wrong with that. Meanwhile, in Germany, Commerzbank AG is in talks with the finance ministry to transfer part or all of its troubled real estate finance unit Eurohypo into government-owned bank. And in the bottom we've got Portugal. The government is planning an intricate financial manoeuvre that could give the country's banks some relief from the mountains of unpaid loans they hold from Portugal's state-owned companies. The state just closed a plan to transfer banks' future pension responsibilities to the state balance sheet in exchange for $6 billion in assets, which include cash, stock and bonds. Most of the money will help the government meet its deficit. All these things are sure they're wonderful and will work swimmingly, but it's best to keep them out of the press because we don't want the market to know about these things, do we? The market might just have caught up with this sort of thing due to the fact it's on the internet. This is Europe as an overall picture. Over on the left side we've got complicated things. It's capital value to GDP ratio, capital value to private consumption ratio and capital value to employment ratio. But basically in the left-hand chart and right-hand chart, the more sticky up you are, the more bubbleacious your property prices are. And the first one is Q1 of 2007. Ireland was the most bubbleacious, Spain next, then France, Netherlands and Italy and Finland were above the euro area average. So we had Ireland, Spain, France, Netherlands, Italy and Finland, but now in Q3 of 2011 obviously Ireland and Spain have dropped out of the picture. The most bubbleacious above euro area average are the Netherlands still, hello, France, Finland, Belgium and Italy. Italy in a very naughty place there. But Netherlands, France, Finland and Belgium, as well as Italy, will have to watch out for housing and construction price crashes because they're in bubbleacious mode. I had to put this in because it's so bloody obvious. Privatizations could help Europe, says Deutsche Bank CEO. Deutsche Bank Chief Executive Joseph Ackermann said on Tuesday, privatizations could help improve the fiscal situation of Germany and other European countries. The government sell off private things to the public area and everything will be just fine. It was just so obvious that I just had to put it in there. And we'll finish with the UK market, who keep an eye on those up over 50s and down under 50s. UK people should read the whole thing, but household finance index. Household finances deteriorate at sharper pace amid survey record rise in debt and fastest fall in income since March 2009. Income going down and the Brits still taking on debt. It's the debt, stupid, that gets you in the end. Bye.